Facebook friends and family. It isn't Monday. I missed this Monday due to getting sick from my kids. They love me and they like to share everything. So I did not get to make a video, but last time I left off that we were going to talk about conventional loans this week. So even though it's not technically Mortgage Monday, it is now Mortgage Wednesday this week. So last week we discussed FHA loans and the benefits of doing those versus other loan types. So this week I want to talk to you guys about conventional loan options. I had an interesting situation come up last week where I met with a buyer whose agent had told her that she needed to save up 20% down for a down payment. They were first-time home buyers. They didn't know really how to navigate the home buying process, and so she told me that it was going to be a couple years before they were able to save up this 20%. That is a myth. You do not need 20% down to get into a conventional loan. We have 3% down conventional loan options. And if you remember, FHA is 3.5%. So it's actually even a lower down payment to get into a conventional loan. In some ways, it's a little more strict. You need to have, there can't really be any blemishes on your credit history. You need to fit into a specific box. They're also called conforming loans because you conform to the Fannie and Freddie standards that they're asking you to do. There's not a lot of wiggle room to get around those. Minimum credit score is 620. Like I said, 3% down. So reasons why one would choose this loan over an FHA loan. If you put down 20%, you never have mortgage insurance. I don't know if you remember, but we discussed FHA has something called an upfront mortgage insurance premium. USDA has something similar. VA has what's called a funding fee. These are all upfront fees. The conventional loan products do not have upfront fees like this. And if you put 20% down, you never have any kind of mortgage insurance. Now, if you don't put 20% down and you just put the 3% down, you have a monthly mortgage insurance fee, but that can go away once you get to like 80% equity or the equivalent of putting 20% down on the loan. Also, conventional loans can be a great option for people who know that they aren't going to stay in their home a very long time. You can do a fixed rate 30-year note, you can do a fixed rate 15-year note. But you also, this is something that you have adjustable rate options. Now, if you think you're gonna stay in your home for a long period of time, I wouldn't necessarily recommend an adjustable rate mortgage because it's fixed for a certain amount of time, usually 3 years, 5 years, 7 years. You'll have one specific rate that is in general going to be lower than your fixed rate options for a mortgage product. However, at the end of that term, whether it's 3 years, 5 years, or 7 years, it adjusts to the market rate at that point. Most of the time, that means your note's gonna go up, right? So if you know you're gonna stay in your home 10 years, there's no benefit to doing a 3-year ARM adjustable rate mortgage. However, if you know you're only gonna be staying there 5 years, it may be worth doing a 5 or a 7-year ARM and getting a better deal on your interest rate than doing a 30-year note. Glitch. Remember, this is an adjustable rate mortgage. If you lose your job, if something changes in your life, if you aren't able to refinance out of that, you are stuck with whatever the rate goes to, whether that's good or bad. So conventional loans can be good for first-time or seasoned home buyers. It can sometimes be a better deal. Example, I met with a gentleman today who actually qualified for both an FHA and a conventional, and we kind of flip-flopped a couple things around because he's saving $100 a month by going with conventional. And he's also getting to waive his escrows, which you don't get to do with an FHA loan, which means that annually he's going to be paying his taxes and his insurance instead of doing it with a monthly payment like you do with an FHA loan or a government-backed loan, VA, etc. I think that's going to be about it. Credit score, like I said, 620. You can do 3% down options. Mortgage insurance goes away after the equivalent of 20% down, or it never exists. We put 20% down at first. But the guidelines are a little more strict in some ways. In some ways, they're a little less restrictive. You know, if you haven't had your job for a very long time, this might be a better option. But anyways, that was our little tidbit on conventional loans. I'll come back to you next week. We'll talk about VA loans. Bye, guys.